What if the most powerful force in the modern world isn't oil, or technology, or even weapons? What if it's debt, not the kind you personally owe, but the kind nations owe, the kind institutions depend on, the kind that quietly determines who leads and who follows? We're told debt is dangerous, a burden, a liability. So here's the mystery. If debt is so risky, why does every major power depend on it? And more importantly, who actually benefits from a world built on borrowing? For most of history, power was measured in land, gold, and armies. Empires rose through conquest and trade. Wealth was tangible, it had limits. But as economies expanded, something changed. Gold and silver could no longer keep up with industrial growth. Governments needed flexibility, especially during wars and crises. That's when credit began to replace metal. Banks learned that deposits could be lent out. Governments discovered they could issue bonds instead of raising taxes immediately. And slowly, debt stopped being a temporary tool and became the foundation of growth itself. The twist? Once growth depends on debt, reducing debt becomes destabilizing. The first major shift occurred when governments realized something powerful. If investors believe in your future, they will fund your present. By issuing sovereign bonds, nations could finance wars, infrastructure, and expansion without immediate resource constraints. More borrowing meant larger financial markets. Larger markets meant deeper banking systems. Deeper banking systems meant more leverage. Debt created scale, and scale created dominance. The countries that could borrow the most at the lowest interest rates gained global influence. As central banking systems expanded in the 20th century, debt became institutionalized. Instead of borrowing only during emergencies, governments began running structural deficits. Why? Because borrowing stimulated economic activity. Lower interest rates encouraged corporations to expand and consumers to finance homes and education. Debt wasn't just tolerated, it was encouraged. And here's the key shift. Economic growth increased tax revenue. Tax revenue supported larger budgets. Larger budgets justified more borrowing. More borrowing expanded the financial system. Debt became self-reinforcing. By the time fiat currencies replaced gold-backed systems, debt was no longer constrained by physical reserves. It was constrained only by confidence. But every expansion carries risk. When debt levels rise faster than productivity, sustainability becomes fragile. A system built on constant borrowing must continue expanding, or it contracts violently.
Ow.
We saw this pattern during major financial crises. Credit tightens, liquidity disappears, asset prices fall, and confidence cracks. And when confidence cracks, intervention begins. Interest rates drop, central banks inject liquidity, governments increase borrowing to stabilize the economy. Each crisis doesn't reduce debt, it increases it. Debt does more than finance growth, it consolidates power. Those who control lending influence policy. Those who issue reserve currencies influence global trade. Those who set interest rates influence economic cycles. Nations that control the largest financial markets often shape international institutions and trade agreements. Debt becomes leverage, and leverage becomes geopolitical influence. The paradox is that the more indebted the system becomes, the more fragile it grows, yet the harder it is to unwind. Governments occasionally promise austerity and balanced budgets, but meaningful debt reduction often slows growth, increases unemployment, and pressures markets. So instead, systems choose refinancing over repayment. Old debt is replaced with new debt. Short-term stress is postponed, and structural dependence deepens. It's never truly eliminated, it's rolled forward. Today, global debt levels are at historic highs. Public and private borrowing combined exceeds global economic output. Interest rate decisions now move markets instantly. Central bank statements shift trillions in asset value. Why? Because debt isn't just a liability, it's the operating system of modern finance. The system requires continuous borrowing to maintain momentum. Pattern repeats. Expansion, overextension, crisis, intervention, and a higher baseline of debt. So let's break it down. First, debt is not merely a financial instrument. It is a mechanism of scale and influence. Second, The ability to borrow cheaply is a form of geopolitical power. Third, systems built on expanding debt require expanding confidence. When confidence weakens, instability accelerates. History shows that empires once fell through invasion. Today, power shifts through capital flows. The question isn't whether debt can build power. It clearly can. The question is, how long a system can expand before the weight of its own leverage becomes unsustainable. If you want to understand the hidden mechanics behind money, debt cycles, and global financial influence, subscribe for deeper breakdowns. Because in the modern world, power doesn't always wear a crown. Sometimes it holds a bond certificate. Thanks for watching.